Hey guys, I'm Abdul Kabeer Syed, and this is my team. We are going to do a financial management team assignment. So let me introduce to my group mates, Ashwinder, Khushman, and Rukshan. Um, I'll be speaking about the introduction and the executive summary. Could you please? So the executive summary says that this report aims to access the performance of Dollarama, a chain of stores which is headquartered in Montreal, using this from its financial statements and the ratio analysis, the financial management tools to interpret and the data and performance of the firm, which shows the market profitability and shows the statements. This report shows the relation of Dollarama's market competitors to its ratio analysis, and this shows about a 5 year timeline of the ratio study. The introduction. Dollarama was founded by Larry Rossi in 1992. Is now one of the biggest, largest chains in Canada for affordable and good quality goods from Dollarama. Dollarama's success lies in the extensive product selection, including fruit, personal items, seasonal items, health, and beauty products. It also provides household, party supplies, and uh, each kind of food items which we can find in any other normal stores. With across 1,400 locations, Dollarama has a dominant presence in Canada and also corporates to the social responsibility, focusing on initiatives like waste reduction, recycling, and sustainable resourcing. Now, I would like to hand over to my friend Khushman, who's gonna do the ratio analysis. Thank you.
Thank you, Abdul. So, starting with, let's just dive a little into what ratio analysis is. So, it is an analysis of various financial data from the statements of a business, and it can be used to understand the financial standing of an organization, along with allowing a comparison with its peers as well as its performance in a specific time frame. So the ratios which we will be employing with respect to Dollarama are current ratio, quick ratio, return on asset, return on equity, and earnings per share. So the current ratio simply measures the organization's ability and capabilities to pay off its short-term liabilities using its current assets. The quick ratio is similar to current ratio, however, it is a bit stricter and it essentially measures the financial muscle of the organization, which would be Dollarama in our case. The return on asset ratio essentially helps in understanding and comparing the value of a firm's assets with the profits it generates over a specified time frame. Similarly, the return on equity calculates the net profits that an organization would generate and based on the equity investments that its investors have contributed in the company. Lastly, the earnings per share ratio. It evaluates the company's net profits and divides it by the number of outstanding common shares, which indicates the money and investing an organization would make for each of its shares. Next slide, please. So for the peer group analysis, we will be tracking Dollarama's performance for the given ratios with its competitors, namely Loblaw, Costco, Walmart, Sobeys, and Metro. So for the current ratio, a higher current ratio is obviously a positive sign and depicts the organization's abilities to cover its liabilities with using its current assets. Here, in this case, Walmart has the best current ratio and Dollarama lags significantly behind its peers. For the quick ratio, uh, Dollarama is once again significantly behind and Walmart tops the list, followed by Costco and Loblaw. Return on asset is a, is a metric where Dollarama is successful compared to its peers. Considering return on equity, that is the worst that Dollarama has, and it has gone into negative values which is not a good sign for the investors. And the earnings per share value for Dollarama is again significantly low, and Costco has a good earnings per share ratio for its uh, investors. Next slide, please. So the time trend analysis, this aids in understanding and tracking the performance of a business over a specified period of years, along with studying changing patterns. For the purpose of this case, we will be tracking and analyzing performance of Dollarama over the past 5 years as depicted in the graph. Next slide, please. So comparing the current ratio over the past 5 years, the company achieved a peak value of 0.28 in the year 2021. And the value was essentially on an uptrend from 2018 to 2021 and dipped a little in 2022. So the quick ratio, which is a stricter and a tighter measure of the current ratio, offers a similar outlook, and the value peaks in 2021. There was again a significant uptick until 2021, and the company experienced a dip in 2022, as per the data they have provided. Next, the return on asset significantly improved over the 5 year timeline, and the highest value was achieved, which was 0.96. The values were on a downtrend from 2018 to 2021, and then there was a spike in the previous year. Furthermore, the return on equity ratio, Dollarama has had negative values for almost all of the years apart from 2021, where it barely managed to make $1.69 for every equity contribution. This is, as mentioned before, not a good sign for the investors and the organization with regards to its ability to generate the returns. And lastly, the earnings per share ratio. The organization has maintained a gradual uptrend in the earnings from 2019 to 2022, and the highest value it achieved was in 2018, which was 4.61. So next we will have Ashwinder, who will be talking about the recommendations for improvement to Dollarama.
Thanks, Khushman. Now I will tell about the recommendation and for the improvement of Dollarama. So the first point is improve profitability. As we can see from the ratio analysis that Dollarama has solid trend in ROA. That means company is effectively utilizing its assets to generate profit, including its resources, equipments, etc. Despite this positive trend, what Dollarama should focus on the profitability of its financial performance. It's like rather than taking, they can take additional steps to enhance profitability beyond what they have already achieved. The second recommendation is to resolve the negative return on equity. As we can see that they are not prioritizing shareholders. So by reviewing the company's financial structure, optimizing capital allocation and implementing shareholders value can enhance the performance of Dollarama. The third point is customer feedback. So, seeking customers' input regularly through surveys and other means, this can improve the customer satisfaction and can spread happiness among customers. The fourth point is risk management. Like any company can do is by uh, measuring the risk uncertainty. This can help Dollarama to evolve and grow more by enhancing their value and to deal with the risk and uncertainties. The fifth point is corporate social responsibility and sustainability. Like the world, in today's world, corporate social responsibility is very important. To achieve a long-term goal, growth, and staying in the market, Dollarama can improve brand value by decreasing environmental impact, helping local communities, and spreading social issues and working upon that. So now Rukshan will continue with the conclusion. Thank you.
Thank you, Ashwinder. So, moving down to the conclusion, we could see both the weaknesses and strengths of Dollarama. Dollarama has a larger return on assets than its competitors, indicating efficient assets utilizing for generating the profit. However, it has such a large assets, yet it needs work on liquidity, profitability, and providing returns to their shareholders. So we believe that the company needs to work on their liquidity, profitability, and returning shareholders. At the same time, they need to make sure that their top priority is to enhance the managemental and the operational structures while implementing and improving their marketing strategies. That is more about like focus more on the customer feedback, because the better the customer satisfaction and the feedback is, the better any company would be generating profit and revenues. However, I would like to say that adapting and shifting to the economical trends, like examining the financial structure, improving the capital allocation, and implementing strategies to enhance shareholder values and reverse this negative return on equity, we could see that the because we could see that Dollarama is financially performing really well and is having positive development. But in conclusion, Dollarama can like compete way better with as a major retailer in this market and cherish the long run and the financial success by implementing the changes that we have mentioned in this research paper. Thank you. And our next slide is going to be our references. Thank you very much for your time and thank you for listening to our research, and we hope you enjoy it.